This is an incoming transmission from the Jersey Shore.
This is Financial Insanity with Scott McLean, powered by McLean Advisory Group. Today you'll hear some of the most important financial information and wealth-building techniques available anywhere.
Let's get this party started, huh?
Do you have a question for Scott and the team?
Am I on the air?
609-488-4646. That's 609-488-4646.
We'll get that information to them by radio.
Now, Financial Insanity with Scott McLean.
Interest rates are on the move again with the Fed's recent vote to cut rates. Now, what would this change mean for you, for your investments, your retirement savings? We're going to talk about that and more. This is Financial Insanity. I'm your host, Alex Dingman, alongside my good friend, financial advisor Scott McLean of McLean Advisory Group. Always a highlight of my week to talk with you, Scott, and feed off your energy, my friend. How we doing today?
The best, thank you.
Absolutely.
We're going to have some fun today. A lot of stuff's going on.
Oh, yeah, no, a lot going on. We're going to talk about this Fed rate cut. Also, we're going to get into corporate bonds, some important things you need to know about that. And then later on, we're joined by special guest Dave Connolly talking about special needs and some important stuff around that.
That's great setup.
Absolutely.
It's going to be great.
No, it's going to be a great program. And I want to remind folks, as always, if you have questions for Scott, the team at McLean Advisory Group, that number is 609-488-4646, 609-488-4646. So, Scott, let's talk about the latest update on these interest rates, as there has been a vote to cut interest rates. Can you get into that a little bit, Scott?
That's amazing. It's about time, but is it about time? And that's been the big question out there. People are excited about cutting rates, but if you're an old bat like me, those of you who like nice high interest rates in your bank account, savings account, there's nothing better than seeing 4 or 5% yields. However, they've been changing with the interest rates cutting. They're going to start to go down. I know we've been doing a lot of information on WBNJ that there's some rates out there currently. I don't know if this is, if whenever you're listening to this show, could it be current right now around 5% fixed rates for almost 3 to 5 years where CDs are paying letters. So there's some tools out in the toolbox we're going to talk about during this show and the next sequence of our show, but there's some great tools. But as interest rates start to drop, people get excited. Housing prices should go up, but they are kind of high because our kids can't afford it. So it's good news in bad news, Alex. And I love talking about good news. Everybody likes good news, but let's be real news. And real news means we do want interest rates to go down when you want to borrow money. You self-employed people and need to borrow money, buy some more equipment. This could be good. You might see because cars aren't moving, new products aren't moving. So you're going to probably start seeing again, 0 interest rate car loans just to keep the economy spinning. So again, a lot happens when feds start to cut the rates by 0.50 basis points. However, some news just came out where maybe because of the economic situation, should they cut again? And that's what's on the plate right now, Alex.
Yeah. Well, let's get some audio here, Scott. We actually have audio from Jerome Powell, chairman of the Fed Reserve. This is what he had to say about this recent rate cut.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Now, Scott, that sounds all well and good, but what do you think here about what Jerome Powell's saying?
I think he's over his skis right now. I think we have to watch it more and more information. That was just a short time ago, and that when you played that audio of him, and we see the market is still strong, and we so understand that the interest rates are going down, whether the politicians are out there saying, I'm going to fix this, or I think I can fix this. I don't know if I can fix this.
Right.
You know, when they look at this consumer price index, it seems to be going down. But remember, audience, listen, they've taken out a few tools on the consumer price index, so your Social Security won't go up as much, which is, of course, your housing, your gas in your car, And when they take out just a few indicators, that happens to be a problem because they're not telling you, as Paul Harvey once said, the rest of the story. So we need to be really careful. Yes, they're lowering the rates 0.50 basis. It's already happened. The question is, what's next? Did they price that in the market? And we saw the market jump. Now, the question is, what if they freeze it? Or could this be a political move? I don't know. I don't want to go in that political game, whether you're a Democrat, Republican, or good looking or ugly. It doesn't matter to me. The question is, what is the market doing when you're investing money? But this could be a real adverse effect to the bond market. And so we're going to talk about that, Alex. I'm glad you brought that up because interest rates change, it affects the bond market drastically.
Yeah.
And so, again, it's going to affect those of you buying your goodies and stuff out there.
No, and Scott, what I want you to do, I want you to give the number for these fine folks out here. If they want to discuss how lower interest rates can impact retirees, can you talk about that a little bit, about what should people be considering here? They hear about this, and what does that mean for folks that are in retirement?
During the time of economic changes and political changes, two different things are happening. Political changes, people are uncertain that whether the Democrats get in or the Republicans get in. That could be a real turning point. Number two, when interest rates go down, people get excited. The stock market gets excited and usually pops up. And sometimes, most of the time, it's priced in. But let's say they do a 50 basis point cut like they thought. But they thought it was going to be maybe 25 basis points. It could really surge the market. Because we did have some people say, Scott, I'm a little bit nervous. Let's wait till after the elections. And that's a normal phone call. But that doesn't usually change a lot. But this next roundabout on how they're going to fix this economy, because it is broken, I'm telling you, that's going to be the big change. Do you have enough money saved, which is a big problem? We've spoke about that, Alex, on one of our programs before. Do you have enough saved? But again, interest rates going down, that's good news for most people. For us older people, it's not that good of news. Where do we find steady, nice, higher interest rates? That's why people actually give us a call all the time, because they want to lock in these nice 5% rates where they're going to go back down to maybe 3-4%. 609-488-4646. 609-488-4646. Give me a call off the air, and I'll be able to maybe guide you through some wonderful places that we've been telling our clients about and people have been calling in. Because as rates go down and you want that steady, I call it the chicken and the egg, the steady dividend to come in or the steady interest payment to come in so you can offset inflation. Maybe you can go take the kids out to eat or your sweetie pie. Well, you know what? Let's get some steady income. And there is places out there still. I don't know about it later in the future, but right now there's some really great places, Alex.
No, and I love that number again, 609-488-4646. If you have any questions for Scott, his team, and McLean Advisory Group, talking today about this 0.5 rate cut here by the feds. And I want to ask you, Scott, the benefits for consumers when the interest rates start to come down. What are some things we could be thinking about that could be benefits here?
Well, maybe you've got your kids living at home, and maybe it's time to put the foot to the dark side of the moon and say goodbye, go buy a house, although the price of the house go down or not. So, again, we're seeing rate cuts could affect mortgages. Maybe for those clients out there, people out there who says, you know what, Scott, I've got a lot of IRA money. Here's a hint. I've got a lot of IRA. Most of our money's in IRAs. Maybe it's a good time to get a equity line of credit. I didn't say use it. I said have an equity line of credit as a backup, just in case you have an emergency. Maybe you get an equity line of credit set in place. That might be an idea. Again, I didn't say use it. I say have it as a backup. And then, of course, we're thinking about the good prices. Of course, we're looking at gas, which affects, again, everything as well. What we spend, could that be affected? So price cuts. We look at the benchmark over the past 23 years. We look at really when Jerome Powell was saying it's going to go down that low. I don't know if it's going to go that low. I don't have confidence it's going to go that low unless there's a big regime change, political move, which could really set this world on fire, which is what I'm concerned about going in the future. So if you can get those rates locked in, it's a great time to really pay attention to income producing tools for your portfolio to have a little bit of extra juice in your portfolio and in your wallet.
Well, and Scott, you and your team, this is all part of that comprehensive plan. You're looking at things like this, things that happen in the world that could potentially affect retirees and their finances. And this is just one of those areas, a Fed rate cut, and this is the kind of thing you see, and interest rates going up and down. You're able to help folks navigate these types of, winds that can come through, whether against you or for you. And so I think that's just a smart thing to hit on, Scott, just the fact that, you work with Scott, you work with the team there at McLean Advisory Group, and whether it's the stock market, whether it's the feds, whether it's who's president, a pandemic, whatever it may be, you're going to have a plan in place to help you, navigate through whatever may happen.
There's a lot of navigation, and right now the stars are not in alignment. They're all over the place. So when you think about where do I go into the market? Okay, the market's been pretty chaotic and exciting for most people. But the question is, could there be a downturn, a massive downturn? We talk about the high debt. I hope they lower rates, because if we're paying high debt, we got to lower the interest rates. But on top of that, we have coming up around the corner where we have Social Security going up with inflation. So could they lower that, which is less money out of the coffers? And we just noticed, of course, these money coming, the FMO, money coming out of the coffers. We can't even handle this hurricane. I don't know if you've been watching this, Alex.
Oh, yeah.
But the latest hurricane, and they're running out of money to help the FEMA.
Right.
It's just totally ridiculous. So we really need to be careful, not only personally, your own personal situation. How do you have a backup? Do you have enough cash saved up? Are we getting the highest rate of return that is safe money? 609-488-4646. You might have questions. I know we've got answers, but again, we have to wait for a lot more other areas. But we do have these answers of how do we make you relax in this time. Again, you feel free to give our studios a call, Alex. If they want, they can simply call 609-488-4646. And by the way, that's our website. Just enter .com. It'll go right there. But I'd love to be able to help you out. George here at our firm is able to help you out. Just a good place, a sounding board to help those of you that want to call in. 609-488-4646, Alex.
Yep. Scott is excited to talk to you, answer your questions about possible opportunities here with this interest rate change. And so that great discussion here on that. And coming up, we're going to talk about something else, Scott. I know that is a big deal, corporate bonds. And really, this is all part of a longer series we're doing here. It's all about having a lot of tools in that income toolbox. And we're going to discuss corporate bonds here in just a little bit. This is financial insanity, out of the box thinking for your financial sanity.
Do you want your retirement to be affected by who's in the White House? We didn't think so. But here's the thing. No matter who wins this time, they'll only be in the office for 4 more years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there's another presidential election in 4 years, then another, and so on. Scott McLean at McLean Advisory Group can help you create a customized plan that's as White House proof as possible. Schedule your visit with Scott McLean today by calling 609-488-4646. Scott doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Scott McLean to get started. Call 609-488-4646. Don't let who's in the White House affect your retirement. Give Scott a call, 609-488-4646. No cost, no obligation. 609-488-4646. Investment advisory services are offered through Sound Income Strategies, LLC.
Get all this stuff and you try to put it away like these hoarders on TV. It has an emotional attachment.
So, Scott, you're saying I don't have to keep every single drawing that my son has done? You're saying I could throw some of that away?
The answer is yes. You can take a picture, then throw it out.
This is Financial Insanity with Scott McLean, presented by McLean Advisory Group.
Today, we are discussing the Income Toolbox, all about building a stronger portfolio, one tool at a time. I'm Alex Dingman alongside Scott McLean of McLean Advisory Group. And I know you're going to have questions. Jot this number down, 609-488-4646, 609-488-4646. Scott knows better than anybody that it takes a lot of different financial tools in your portfolio to keep your retirement on track. We're going to talk today about corporate bonds and the difference later on between corporate bonds and mutual fund bonds as well, because that's an important distinction. But Scott, let's, if you would, kind of display the power here of bonds and why we're talking about this here today.
I'm so excited about talking about bonds because I think about Jack, a classic growth investor. They want to grow your money. And he rode the waves of the stock market up and down for decades, enjoying the high and the enduring lows. But, as Jack, or maybe you out there, you get closer to retirement, you start losing a little sleep. Or maybe you got that spouse of yours putting an elbow in your side thinking, every time the market takes a dip, honey, you change your personality, or perhaps maybe you lay awake at night hoping and wondering by osmosis, will the market go back up? And of course, you learn the market's up and down, and you could possibly seeing your gains turn into losses. So again, we'll use Jack. He wants to start selling his stocks because why? He needs income. Write this down: reverse dollar cost averaging. You see, when the market's down, you're faced to sell when you have this income you want, and you have to sell at lower prices, which means you're selling more shares to get the same income, reverse dollar cost averaging. You see, one day, particular volatility, if the market's really swinging up and down, not only is your personality changing, I've noticed so many times, Alex, I'm sure you've seen the seniors, their personality changes. The market's up, you're happy, market's down. I say go to the doctor and get some Prozac, but pretty much you're on your way to keeping your money safe. We need income. Tools that will pay a consistent income, whether the market's up and down. It's almost like a loan. So corporate bonds, as we talk about, it could be great. Now, imagine this: instead of stressing out about the markets up and down, you can pretty much get yourself a nice tool. You don't have to worry about the markets. You're out to dinner. You're playing with the kids. You're watching the football, the grandkids playing. And like clockwork, the check shows up in the mailbox or in your checking account, just as promised. So this could be a great tool. But those in the stock market, in the growth area, you don't understand how it works because you really haven't been in that world. And when you change from the growth world to the income world, it's a different world to understand. And it's almost like going deep sea diving. Are you used to it? Can you handle it? Can you sleep well at night? This is income, predictable. You can bank on it. And of course, this is what I find so important, Alex. Is people don't understand how to look at it in this time of possibly a great time for corporate bonds.
Right. Well, then that's what I was going to say. It seems like it could, take some of the stress out of investing, especially people as they're approaching that retirement, maybe want more of a quote unquote sure thing. But talk to me a little bit more. Okay, what exactly then are corporate bonds? How does this work?
Think of, Alex, your name is IBM. And you want to raise some money for some reason, so you're going to issue a bond. And you're promising to pay me, Scott McLean, or the investors online listening to us right now, in writing, a documented piece of paper called the bond with the stated date when it's due. Maybe you're going to have a stated interest rate. Let's just say it's 5%. And you must pay that no matter what, hell or high water. And you're banking it almost like it's like a loan. And so you're going to pay me twice a year as a corporate bond. So we know two things. Number one, we know the interest rates and we know when it's coming due. Now, what coming due, Alex, means really clearly, coming due means I got to give all the money back. So, Alex, if you loan me $100,000, or I'm saying I give you $100,000, Alex, for your bond, and you're paying me 5%, and the bond is called in 5 years. That means you've got to pay me a semi-annual payment 2 times a year, and at the end or the call period, when it's over, you've got to give me all my money back. So I'm just eating the interest. I call it the chicken and the egg. The chicken is the investment. The egg is the dividend or interest payment, and I'm getting that egg so I can either eat the eggs or I can reinvest the eggs and buy more chickens. And this is what's a lost strategy in the world of investing for fixed income. And don't misunderstand this for mutual funds. We'll talk about that later. Mutual fund bonds, but understand corporate bonds could be a wonderful place, Alex.
Well, and Scott, for folks out there that
Want to learn more?
609-488-4646. Again, 609-488-4646. I'd love to hear from you.
No, thank you so much. And, one saying my mom told me as a kid was, if it sounds too good to be true, it probably is. And Scott, I know you're a straight shooter. Let's talk about the corporate bonds. We talked about maybe some of the safety there, but break down the good, the bad, maybe the ugly about corporate bonds, if you could.
Beautiness of the corporate bonds is, number one, we have to see who the company is. Let's take a look at the company and rip it apart, and let's see if they can pay the interest payment. Let's see if they have too much debt. Maybe we don't want to go in a corporate bond. Let's rip off the facade of how beautiful the company is, like General Motors. When General Motors was a big company and people bought their bond, well, remember, General Motors became bankrupt, but they got 18 cents on a dollar. They didn't get the full money back. So be careful when you're investing for corporate bonds. That's the ugly. The good, let's say it's a very strong company. My friend out there, Public Storage or IBM or some strong companies. Well, we know that they can pay. They've got a strong balance sheet. We know that they're issuing a bond because they want to expand their business or whatnot. We're going to look at these corporate bonds and the safety of the corporate bonds. That doesn't mean they're guaranteed. It means, well, if they have enough income, that they have enough profits, they have enough assets, they could be a wonderful tool. Unlike a company called Xerox that used to be around. Of course, I think about other companies out there that could be maybe weak. Let's make sure they're strong. The good, I'm getting a check. I can bank on the check. The wonderful, I'm going to get a corporate, and after the period of time when the period is over, called the call date, or when it's ended, I'm going to get a check, like the Tiger Bond. The Tiger Bond in many years ago, which was the Treasury, was paying, 13.25% guaranteed. And you know what? What a great bond that was, guaranteed by the government. So let's take a look. Again, that's the government bond, but the corporate bond, let's look at the company. The good, the steady check. The bad, if it's weak and you buy it and you get caught in hype. The ugly, they go bankrupt like General Motors did, and you get pennies on the dollar. So this is important when you're looking at fixed income, that the advisors who really don't specialize in this area, almost like a knee surgery specialty or brain surgery, you've got to really dive into the nitty gritty before you buy this corporate bond. But the good news, oh my goodness, we don't want default. That's the ugly. But the good news, the steady check. You can bank on it showing up in your mailbox twice a year.
Well, and Scott, I love your energy for helping folks and for educating people, and the knowledge that you have here about different income tools as we're discussing corporate bonds today. But I can just feel it coming out of you that you're it's something that you just feel like it's really important, because it's something that you think that people are not educated enough about, right?
They're not. And unfortunately, I'm the old person in the house talking to you young people out there. What do I mean by old? You see, in 1982 to 2000, the market was nothing. Well, there's a couple dark skies, but it was blue skies. Anything you touched, anything you felt, anything you smelled, anything you invested in, it made money. So who the heck wanted to buy a smelly, yucky bond? Bonds are boring, Scott. I'm getting a steady payment. Yet the market's making a 5, 7, 10, 15% rate of returns.
Right.
And you are bored with this boring bond. And now a 2000 kicks in. The price to earnings ratio is 44-1. It was too high. It was a major indice. As we spoke about in the market, it's time to get out. Let's get out. Well, people didn't want to go to bonds. They were looking for the blue skies that turned into dark skies, and the market dropped from 2000 to 2002, and the market dropped. That's right. It dropped around 48%. Some mutual funds and stocks dropped even 55%. But if you want that steady income, this, when you get older, could be a nice steady income, a great tool. I didn't say sell everything you have out there. Listen, make it very clear. I'm saying you need to understand, because people were not being educated on duration. They were not interested in, they were not understanding guarantees or what the companies were guaranteeing by way of paper. And they were not understanding how can I get paid. And therefore, that was put aside, hoping and praying that the market would continue to go up. And when it dropped from 2000 to 2002, from 2007 to 2009, people were nervous. They couldn't sleep, Alex. Bonds could be a great tool out of all the tools in the fixed income area. And this is one of the wonderful type of tools if you'd like to sleep well at night and get that check in the pocketbook.
Want to learn more?
609-488-4646. Please write it down, 609-488-4646. I'd love to take your questions. I've got answers. And if I don't have answers, I promise you I'll get them.
That is Scott McLean, McLean Advisory Group. Remember the website as well, financialinsanityradio.com, as we're talking today about some different tools that you need to have in your income toolbox. We're discussing corporate bonds, but on the other side, an important distinction needs to be made. We're going to be talking about corporate bonds versus bond mutual funds. This is Financial Insanity, out-of-the-box thinking for your financial sanity.
Who likes uncertainty? Wall Street certainly does not. With near record inflation and partisan politics, there's a lot of uncertainty right now. What will America's future look like? What will your future look like? Will your taxes go up? Will your savings go down? For more than 40 years here in the Jersey Shore area, Scott McLean and the team at McLean Advisory Group have seen uncertainty come and go. No matter what the future holds, Scott can help you create a plan designed to preserve your finances in uncertain times. And it's not a matter of if those uncertain times will show up, but when. Call 609-488-4646 now to meet with Scott McLean and the team at McLean Advisory Group. If uncertainty is causing you to feel insecure, Scott McLean might be able to help. Call 609-488-4646 and schedule your visit today. Again, that's 609-488-4646.
Investment advisory services are offered through Sound Income Strategies, LLC. Investing involves risk, including the potential loss of principal.
Do you want your retirement to be affected by who's in the White House? We didn't think so. But here's the thing. No matter who wins this time, they'll only be in the office for 4 more years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there's another presidential election in 4 years, then another, and so on. Scott McLean at McLean Advisory Group can help you create a customized plan that's as White House proof as possible. Schedule your visit with Scott McLean today by calling 609-488-4646. Scott doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Scott McLean to get started. Call 609-488-4646. Don't let who's in the White House affect your retirement. Give Scott a call, 609-488-4646. No cost, no obligation. 609-488-4646. Investment advisory services are offered through Sound Income Strategies, LLC.
Can we really live the go-go years, or am I going to scrimp and save and stay at home and watch TV, watch Bob Barker? I don't know.
Nothing wrong with that.
No.
We made it back. This is Financial Insanity with Scott McLean, presented by McLean Advisory Group.
Discussing the income toolbox today, building a stronger portfolio, one tool at a time. I'm Alex Dingman alongside Scott McLean of McLean Advisory Group right here in Waretown, serving Ocean County and beyond, helping you shore up your retirement future. That number, if you have questions, 609-488-4646 for Scott McLean and the team at McLean Advisory Group. As yes, we are talking about some different tools to help you generate some retirement income, discussing corporate bonds today. Very important topic, and we need to make an important distinction here, Scott. If you could talk about the critical difference as we are discussing corporate bonds, but also what a lot of people know about maybe are invested in our bond mutual funds. What's the difference here? What do people need to know?
Let's get to basics. First of all, if you're out there and most people don't know about bonds and how they work, or maybe you have a little ideas, a bond is like a loan from a corporation. A bond is like a loan from a corporation with a set period of time called duration. So let's say it's IBM. They're going to offer a 5% bond, and it's for a 15-year period. So we know how long they have to pay that payment. Now, that's called a corporate bond. Again, we have all sorts of corporate bonds, from the risky to, of course, real conservative ones. That's called the quality of the bond. Now, let's jump over into the world of mutual funds. This is where it gets tricky. And a mutual fund bond is made up of 200 to 300 different companies in one portfolio. So you could have one bond mutual fund with 200 to 300 companies in that portfolio. Now, if you were to say, Scott, I want to have safety and security, well, my question to you out there, listen carefully. Let's say I've got a mutual fund bond portfolio that's paying a 5% dividend. And let's say I have a 10 different corporate bonds, 10 different ones, that's averaging 5%. On one hand, you're going to say, I'd love to have the diversification of 200 companies versus 10 companies. Well, wait, did you understand who's offering better guarantees? Let's break it down. In a corporate bond, we know how the corporation's going to pay you and how much. So each individual bond, by way of, they write it out on the bond, they have a promise. But in a mutual fund, the mutual fund manager has, again, 200 companies, well diversified, right? But wait a minute. If the market is dropping and people get scared, you're going to be caught in a mutual fund portfolio as the market is dropping. But if you're holding individual bonds, you can choose to, I'm not dropping anything. I like that steady 5%. I'd like to have that guarantee of the company paying me a monthly, or I'm sorry, a twice a year, that payment. And I know I'm going to get that payment for a certain period of time. So I've got certainty and guarantees by the corporation. Now, I'm not guaranteeing the corporation is going to go out. I'm saying, let's take a look. So as an investor, portfolio manager of these portfolio of 200, I'm not going to talk to you, my clients out there. I'm just going to buy and sell what I need to. So when people are redeeming money, I may be selling some very good bonds just to make up the yield. But you out there, individual, you can keep these bonds. Now, let's make it, you know what? That's really deep, Alex.
Yeah.
Do you want some certainty? Individual bonds have more stability than mutual fund bonds. How about that? Make that real simple. Why? Because we don't know when the market's dropping and you want to sell, you know what? Or you don't want to sell, but you want to enjoy that 5%. They may have to liquidate, and this loss could be a permanent loss in a mutual fund portfolio. It's just a stock of a bunch of bonds. And this is where people don't have that predictability, that accountability. They don't know what's inside of it. But when we have individual bonds, we can look at them, we can analyze them, whether we should get out or not get out. And this is a big difference when we talk about the difference between mutual funds, bonds, portfolio, and individual bond, corporate bonds.
Want to learn more?
609-488-4646. If you're stuck in the weeds, give me a call off the air, 609-488-4646. That's our studios. If we can help you, let's help you, because bonds are tremendously exciting now as interest rates are starting to go down.
No, I love it, Scott. And really, it's all about that level of risk. You know, how much risk you want to take? How much do you want to be into the stock market? And I think that conversation, too, it is a different one as you get closer to retirement, right? So maybe discuss that a little bit. As, you know, you're getting closer to retirement, maybe, depending on who you are, maybe that's the security that you're looking for.
I really don't want people to get thinking that all bonds are safe.
Right.
So I'm very nervous what I just said a little while ago, because they're based on, number one, how long you got to keep them, called duration. But on top of that, you could buy what's called high yield bonds. Now, people get excited about high yield bonds because they think, oh, I'm going to make a lot of money. Woohoo! Wait a minute. High yield bonds are the riskiest, because there are companies who have the portfolios don't look too good. Maybe they need some right guard because they're starting to smell. Maybe they need to raise money, high yield bonds. And so lately they've been absolutely just catapulting, doing wonderful because it's hard to borrow money. But when interest rates start to drop, do you want some guarantees? Do you want to sleep well at night? Let's find a tool in the toolbox called corporate bonds, whether they're risky ones or not that risky ones. Let's understand your risk level, because everybody wants cake and ice cream, but nobody wants the calories, the extra fat. So be careful of how much risk you want, because there's several types of bonds out there people really don't understand, and they could get stuck in the muck. That's why they give us a call, and when we talk to our clients about where they want to invest their money, we call it the dreams. I want the money to come in. I want to be able to take trips. I want to go on trips and not worry about the market. Then we talk about the dollars, where to invest the money, and the tools that'll give you those dreams to come true. And then if we pass money on to the children, called the dynasty, how does it pass on? Do the kids usually cash everything in at once or not? And this is the definition of really a 3D planning in your portfolios. And bonds could be a good mix as rates go down. As we just saw previously, the rates were skyrocketing. Bonds took a real, they became a anvil around your neck. They were dropping like a time bomb. Now it's inverse. It could be a wonderful tool out there. So again, understanding your tools is critical, Alex. If you don't understand, call us.
Well, and no, that is a great point. And also the idea of allocation as well. I mean, Scott, could it make sense to be in a world where you have both corporate and mutual fund bonds?
It could be. It could be, depending on the size of your portfolio, depending on the risk you want, depend on the income that you want or non-income, depending on the current markets. As we know from our previous show, we talked about the interest rates are dropping. Jerome Powell had a little conversation with us previously. And then we talk about, is rates dropping? Should we be into bonds, not bonds? And again, it goes back to the mutual fund manager who's handling it. Let's see his track or her track record, because we don't want to get caught in this ride as interest rates start to drop. Is it a short-term bond or long-term bond? Where do we go? And this is the unique tool where our firm really lights up and really does tremendously well, because we have in our back pocket 3 CFAs to make a quick phone call and to have guidance to where we should put money on a daily basis if we need it. This is really helpful to us.
Well, and Scott, it's all about creating that custom plan. I mean, you threw out the word unique, but each person is unique, and they're going to come to you, and you probably get tired of saying, well, it depends, but it really does. It depends on a person's personal situation, their income level, what they want to do in retirement, the kind of legacy they want to leave, and so it is custom for folks. And so as we have this discussion about bonds or any other income tool we're talking about, there is no one size fits all. And that's one thing that your team gets really excited about, is somebody coming in and it's a blank canvas and you're just looking at it and saying, hey, fill me with all the knowledge so I know who you are, what you're trying to do. And then you're going to use your knowledge and your team to try to craft a plan that's going to set that person up for the most success they can have.
We have tremendous variety of people, not only for the colors of the people, the good looking or the ugly ones like me, but we have people who are married, and they're married and they start their retirement journey at age 60, some 55, some 65, some older. Maybe they have younger spouses. Maybe the one spouse is 75 and the other spouse is 60. Wow, is that a diverse journey? How do we make the money last longer? What tools should we use so the money lasts a good long time for the younger spouse? And that doesn't mean that the younger spouse is going to live out the older spouse. In addition to the ride, in the early years, it's called the go-go. You want to go, see things, enjoy life. Like my best friend, his wife is about 12 years younger than he is. And they said, Scott, my wife, I'm going to have her retire right now. He is 65 right now, and his lovely wife is younger, and they want to start doing things. Well, you know what? Their planning is going to be different than if they were both 65. Or maybe they have a certain amount of income they need to last a good long time. Or maybe they're older. Let's say another couple out there that could be both 75. Do we want to pass money on? Where do we put it in? How much do we need to pull out? How do we pass the money on so the money lasts a good long time for them? Should we put the money into an irrevocable trust to hide the money from the nursing homes? Should we put the money in a different type of account to have some more growth? I don't know. And Alex, you made a good point. We have such a diverse amount of people out there. This is exciting. What makes me excited about my field, I mean, if I can last another 20 years in this field, I just love this because everybody's so different. It's not the same old, but everybody has the go-go years, going into the slow-go years, going into the no-go years. And so things change, Alex, and I think about this. What are you out there? If you're looking at retirement, how are you looking at retirement? What are you doing? How are you setting your retirement up? Are you talking about this on an annual basis with your advisor or on a semi-annual basis? And then are you looking at tax ramifications? And then how do I preserve the assets for the next generation? Hey, if you want, give me a call at our studios. You may have questions right now. 609-488-4646. Let me say it again real slowly because I don't want you to miss out to understand how mutual fund bonds, corporate bonds, and other type of investments out there could really be beneficial at this time. 609-488-4646. And by the way, that's our website, 609-488-4646.com.
Thank you for that, Scott. And when we come back, we're going to have a guest with us, Dave Connolly. We're going to talk about some important things you need to know around the topic of special needs. That's on the other side. This is Financial Insanity.
Stop for a moment and think about this. Do you know how much money in your 401k or IRA is actually yours? Or will the government take a bigger chunk than you thought? Remember, you still might owe taxes on that money. But do you have a plan to help make sure you don't pay more than you should? At McLean Advisory Group, we believe you deserve to keep more of what you've earned, which is why we're here to help you navigate the confusing world of retirement taxes. It's your money. You deserve to know what's at stake. Right now, taxes are historically low, but they won't be this low forever. So call the McLean Advisory Group team today so you don't miss out on this opportunity. 609-488-4646. That's 609-488-4646. You work hard for your money, and we'll work just as hard to help you keep it. McLean Advisory Group, 609-488-4646. Investment advisory services offered through Sound Income Strategies, LLC, an SEC-registered investment advisory firm. McLean Tax Advisory Group and Sound Income Strategies are not associated entities.
How much cash are we going to burn, and will you be out of money? And will the cat food train start to come alive? And that's where the rubber meets the road.
Great cat impersonation, by the way, Scott. That was spot on.
This is Financial Insanity with Scott McLean, powered by McLean Advisory Group.
The basics of special needs benefits and trust planning. Talking about that today. This is Financial Insanity. I'm Alex Dingman, alongside, as always, Scott McLean of McLean Advisory Group. And then also, maybe his better half, I don't know, but special guest Dave Connolly, lawyer in the area for over 40 years and is now a consultant for the firm of Elizabeth Apollo, of course. But Dave, coming in here to educate us a little bit about a very important topic, because maybe your current advisor hasn't asked these important questions, and this is something that should be checked in on a yearly basis because things can change. But talking about taking care of someone with special needs and talking about the benefits that go into that. And Dave, this is important stuff because there are resources out there that folks might just not be aware of.
Absolutely. With a special needs child, or adult, you want to be able to take advantage of whatever government entitlement programs there are. There are a myriad of different programs out there. Some of them are means tested, which means that they're critical on your assets and your income. Others you're entitled to regardless, depending upon how long you've worked. The Social Security office would administer them and will determine whether you qualify or not. But the more important ones are Medicaid and SSI. Those are means-tested programs that you have to qualify for. The SSI will pay for your shelter and food. the Medicaid, which is more important, will pay for your medical, such as long-term care, home care, provide you a myriad of different medical resolutions. And if you qualify, it becomes very important to maintain those benefits. The problem is that parents or other people that want to take care of a special needs child or person, they don't understand that if they provide income directly to that person, they get kicked off the entitlement program. And when you're living in a long-term care facility that's costing $12,000 a month and Medicaid's picking up the tab, if you get kicked off, you got a lot of problems. So proper planning has to be performed in order to provide some assistance to the disabled person who is getting the entitlement programs.
Very important. And if you hear something today, the number 609-488-4646, 609-488-4646. And Dave, it seems like an obvious question, but why is this so important? What are some of the challenges that somebody is going to face, especially financially, if they are taking care of someone with special needs?
Well, you want to maintain that person on the entitlement programs, as I indicated before. So what does the trust do? The Special Needs Trust provides a quality of life that will allow that disabled person to maintain that quality and still maintain the government assistance. For example, the Medicaid program will pay for the long-term care facility, but other things such as transportation to and from the doctors, recreation, a computer, all of these items are not addressed by Medicaid, and as a result, the Special Needs Trust is set up so that it will provide these tools to the disabled persons to bring them up to a quality of life. So you got a twofold problem: one, to keep the medical benefits flowing in; two, to bring the person up to a quality of life so that they're not just the basic having their bills paid, the medical bills paid, but have no quality.
Alex, I'm thinking as Dave is sharing this critical information, as we look at clients on a daily basis, we're always asking, how is your wife feeling? How is your husband feeling? How are the kids? Tell me how the kids are doing and the grandkids. This determines, it starts from the first appointment when we ever meet with people to really dive deep, to make sure that all areas of your finances that you're listening to us right now, you out there right now, are all areas buttoned up. And the reason why I say are they buttoned up is because people may not have asked, by the way, how are the grandkids? The reason you ask how the grandkids is could be a special needs grandchild and what kind of benefits. Because if they have in their language per stirpes to pass the bloodline, and then mom and dad pass away and their son had passed away previously, it goes to the bloodline. Now, this is so critical to ask your advisor on a yearly basis, at a minimum on a yearly basis. Hey, are we buttoned up so the Uncle Sam, the crows and the clowns don't show up at the funeral to take my money? And we talk about that in chapter 11 of my book, which is why when I worked with Dave for tech since 1983, 84, so many years, and there's a lot of good attorneys out there, but do they work with their financial advisor and their tax advisor as they conglomerate, they collaborate together to protect your assets? And the purpose of these trusts is to what? Protect assets, and to get as much that you've paid into the government, you get out. And this is the mistake I can tell you I see so often, Alex.
Absolutely. And that number, 609-488-4646 for Scott and his team at McLean Advisory Group, 609-488-4646. This all part of that holistic approach. That's why Scott brings in a guy like Dave. Not that Scott's not really smart, but he knows to even bring around even smarter people than him to help him with this important stuff.
I always have smarter than people than me, Alex. It makes me look good. But here's the challenge, Alex, as you brought up, which is really, really wise. If you haven't brought this up to your advisor, feel free to give us a call. And the reason why you'd call us is maybe if you want to speak with Dave or speak with Elizabeth, or speak with someone who does this. They do this all the time. This is not a surgeon that is doing surgery once a month or once a year. You need to know the game because the rules change so often. And when they change, if they miss one dot, one iota, one area, this is where the problems come out. And when the problems come out, that happens to what? More chaos. And
Right.
so your money could be at risk. Hey, if you want to get a hold of Dave, call my office. He does the estate planning, then along with Elizabeth. He's our consultant here at 609-488-4646. This topic no one likes to talk about, but I like to talk about it because, again, it's part of buttoning up, making sure your finances are really set up and as best as possible bulletproof for any of the crows and clowns that show up at the funeral or shows up when your lights are going dim, or maybe your spouse's lights is going dim, and your spouse, maybe you need to have an irrevocable trust. Maybe you start setting assets for your mom and dad. Dave, which he didn't say, is a veteran receiving 100% of veterans benefits. He served in Vietnam and he survived it, although he's gone through a lot of challenges. But I will tell you, if you're a veteran out there or a spouse of a veteran, there's also benefits including the benefits that we're talking about today. And this trust could be a great piece of your discussion. Hey, give me a call off the air if you'd like to talk to me, no cost. We're not going to spin you or twist your arm. People have known me for how many years now? It's 13, 14, 15 years on the radio now at 609-488-4646. If we can guide you, if you want me to get a hold of Dave and maybe put you guys together, no cost, no obligation. You can ask him some questions at his office. Please feel free to give me a call, 609-488-4646, because there's nothing worse, Alex, than procrastination. And that is the demon of finance I've found so often.
Absolutely. As that is Scott McLean. We're being joined by Dave Connolly, also lawyer in the New Jersey area for over 40 years, now a consultant for the firm of Elizabeth Apollo. And we're talking about something very important today. We're talking about special needs benefits. And you hit on something, Scott, there that I think is important, and that is just who are we talking about here when we talk about who qualifies for this? Both when we're talking about someone with special needs, and then also we got to think too from financial. Is there some sort of threshold, or how do you qualify for something like this?
Yeah, most of the time to qualify, you have to be disabled. For some programs, such as Medicare, which is definitely not needs-based, everybody qualifies for Medicare who has worked and has turned 65. Or there's other certain requirements for younger people that they can qualify.
Why are you looking
also
at me, Dave? Oh, I'm turning 65.
So certain programs are needs-based. So there's all different programs. But if you want, we're working on a paper in our office. If you call Scott's office and leave your email, we'll email you the paper, and you can get at least the background. Then you can decide whether you want to pursue it or not.
And what about some common misconceptions or mistakes when it comes to special needs planning? Because I know without some guidance, there's probably some opportunities or some mistakes that could be made if you don't have that guidance.
I think it's the intake, number one, the intake form, the information that you receive. Did they drill down and get as much information as possible? Number two, when can you apply? And is there a time limit? Could there be like a 5-year look back provision? I got a phone call last week where someone says, yeah, we're going to transfer the assets into all 3 of my children's names and we're good. And I'm saying, you're not good. You're still in trouble. You still have the 5-year. And imagine one of the children spends 1/3 of the assets. The other 2 has it. They're going to come after that 1/3 of the assets. So this is a problem, Dave.
Oh, absolutely. Without proper planning, you're not going to get the entitlement or the needs-based benefits. The trust is there to allow you a quality of life while you're still maintaining your SSI and Medicaid benefits. If you qualify for SSI in New Jersey, you're automatically qualified for Medicaid. The qualifications for Medicaid are quite complicated. They're hard to. It's a hard process to go through. But once you do qualify, they're picking up $10,000 a month for the long-term care, which is a lot of money if you're in there for 4 or 5 or 6 years.
And why not protect your assets? Hey, this is Scott McLean. If we can help you, we would love to help you. 609-488-4646. Financial planning is not just easy. It's not a set it and forget it. This is why you give our studios a call. This is you. Maybe you're facing this. Maybe you're going into this area. 609-488-4646. I'd love to talk to you off the air.
Scott opened up the Veterans Benefit Advisory Group in 2008 to help veterans and their families, guiding them to these important benefits. Again, that number, 609-488-4646. The number for Scott McLean, McLean Advisory Group, 609-488-4646. And again, a special salute and thank you to all of our veterans.
This radio program may contain information which has gone regulatory or other significant changes since its original recording. The information and views expressed on today's show is educational in nature and is not intended to be a recommendation for any specific investment, product, strategy, plan, tax, or legal advice. Information presented is believed to be factual and up to date, but we do not guarantee its accuracy. Investment advisory services offered through Sound Income Strategies, LLC, a SEC-registered investment advisory firm. McLean Advisory Group and Sound Income Strategies, LLC, are not associated entities.
This radio show is a paid placement.